Guys, this is reinforcement of notes receivable, and we're talking about notes receivable for an entire year. And so remember that receiving notes and then getting them paid to you on a regular basis is an ordinary part of business. Um, I want you to know and understand that sometimes those notes go for a whole year. Those short-term notes that are owed to you by someone, some other company. And it may be that as part of the promissory note, that interest will be paid at a certain point, um, even before the note comes due. And you might collect it, say at differing times, so forth. But in this particular problem, they just kind of take a whole approach and they say, okay, this is the average amount of notes that you had receivable, and then you have this average amount that is recorded as interest. So just don't get too confused by that. If you'll see here in A here, I've gotten this 22,050 by multiplying the 525,000 times the 4.2%. So I got the total amount of interest on that 525,000 worth of remember, these are notes receivable, right? So what we realize is at the end of the accounting period is that we have some interest revenue from those notes that we need to also record. This is kind of an adjusting entry, like at the end of the accounting period. And so what we've done is we've kind of created a receivable, and we've also booked that revenue. And so we want to make sure that that gets on the income statement for this year. So we go ahead and make this record. But then the amount that is owed us then shows up as a receivable on the balance sheet. So you see interest receivable will be on the balance sheet, and interest revenue then of course will be on the income statement as of the end of the fiscal year. Now what I want to show you is that this balance here, they didn't really give us a balance in interest receivable. In B, they say, hey, look, interest receivable went up $6,400 over the year, right? And then they say, well, how much interest did you collect, right? So what we want to do is kind of take a look at a peek at a microscopic look here at one account, and that is the interest receivable account. And we want to try to figure out how much interest was collected. Now you'll see here there's question marks, like they didn't give us the balance to begin with. They didn't give us the ending balance. They didn't give us the interest collected, but they did tell us though that this account went up $6,400. So if you'll see down here, I've just kind of recopied it, and I've put in some numbers. I've said, look, what if we started out with 0 in interest receivable, and then we wound up with 6,400? Well, if we do that, then we can take this 22.5 that we already know, 22.50, excuse me, and we can subtract out that 6,400, and we can get the interest collected, which is 15,560. Now, once we do that, then we make a journal entry. It says, well, okay, what happens when we collect it? I mean, isn't that what B asks us to do, is write the journal entry to show the collection of this amount. So guys, whenever we collect interest, it's going to be in cash, and then we're going to have to decrease our interest receivable by that amount that was collected, right? Okay, so that's the journal entry associated with this illustration within the T account. But I like to stop and just let you guys understand that it could be any amount, guys, that's above that increases 6,400. Keep in mind that this up here could be 3,000, and this be 9,400, and that way it would have gone up 6,400. So as long as the beginning balance that you make the assumption of is $6,400 less than the ending balance that you make the assumption of, then you can come up with the number on the other side of the entry, right? Of the account, the other side of the entry. So that makes this 6,400, which is the interest collected. So I just wanted to kind of, this is a lot simpler than the way that the author sort of, you know, presents the material to consider this problem. You know, refer to the author's solution, of course, for the way in which you calculate the math equation. But I just wanted to give you a little bit different overview and perspective and talk over this in a little bit different outlook. So hopefully this will be helpful.